leverage. What are the how the liquidity and how the leverage is impacting the liquidity, and how these are overall causing or adding more to the risk, and probably what are the mechanisms that are available to manage or control them. Because the leverage, if you are able to control the leverage, probably there is the liquidity risk that can be reduced, which can give more and more value addition to the firm. So understanding the relationship between these two important variables, and also how each one is contributing to the other, that is one thing which we will look at as a part of this session. So just to start with, whenever we talk about liquidity, the major thing that we should look out for is how quickly I can convert any of my assets into cash. The quicker I am able to convert, highly liquid that asset is. And that too, the quicker with very little extra cost, preferably no extra cost. The more and more quicker with very less cost I am able to convert an asset into cash, means I am able to sell. There is a market for purchasing the asset which I am ready to sell. That kind of securities are called as highly liquid securities. So even when I am into a trading position, I should be able to exit that position or offset that position without too much compromising on the price. Those kind of assets, those kind of securities are called as liquid securities. Now when we talk about the word liquidity risk, it is more to do with the chance that I may not be able to sell the security at the current market price without incurring any additional costs. That is what is coming out to a liquidity risk. In this, there are two major categories of liquidity risk which we look at. One is with respect to the transactions. I'm not able to buy or sell without compromising on the price or without an additional cost. I'm not able to buy or sell a particular asset, which means if I have to sell an asset, I may have to sell it. I'm forced to sell it at a reduced price because there is no market to buy it. And if I am thinking of buying a particular asset, I may have to pay an increased price because there is no market to sell it. So what we see is the sell and buy prices, the gap between them, which is called as a spread. The spread will be more in case the liquidity does not exist in the market. That is what sometimes we call, if the liquidity is not existing, then the bid to ask spread will actually go up, because the bid is the price at which an individual investor wants to sell, ask is the price at which the individual investor wants to buy. So the gap is getting widened. That is what is an indication of the liquidity risk. So whichever risk we are talking about, the financial transactions, and whenever I am not able to buy or sell an asset without impacting its price drastically, then I am exposed more and more, then that asset is exposed more and more to a transactions liquidity risk. Whereas on the other side, there is another form of liquidity risk called as the funding liquidity risk. So it is, I'm not able to raise capital without compromising. So it is more and more to do with the balance sheet risk. I mean, otherwise it's also called as the balance sheet risk or the funding liquidity risk. So one borrower's, let's say the credit position is getting deteriorated, right? I mean, a company undergoing more and more losses, the credit position is getting more and more deteriorated. So he is not able to raise additional capital also, and not even not able to raise additional capital. Existing lenders, wants to close their position. They demand their money back. So they demand their money back, or they change the terms and conditions of the loan. All these things create heavy cash crisis within the organization. Especially in the banking sector, the funding liquidity risk is very high because of the maturity mismatch. Generally, if you see the bank portfolio, the assets of the bank, which generally are loans, they are long term, right? The loans might be given for 3 years, 5 years, kind of, or even housing loans for 20 years, 30 years. Whereas when I look at the liabilities, where deposits are the major chunk, generally the deposits can be withdrawn whenever required. They are very, very liquid, right? It means I should look at them as majorly short term. So my liabilities generally are short term from a bank's perspective, whereas the assets are long term. This is what we call as maturity mismatch. So the funding, so what banks typically do is they fund these loans using the deposits. This is actually called as fractional reserve bank system. Fractional reserve banking system. Why I call it like that is I'm using the less matured or less security or less maturity liabilities, less maturity funds for funding high maturity assets. So liabilities and assets are getting mismatched, funding the long term assets with the short term. So it is very profitable to the bank also, because if I am borrowing for a short term, deposits are nothing but borrowings of the bank. If the bank is borrowing for a short term, it is getting that capital at a very low cost, low short term, less risk, so less return can be given. So the cost of capital for the bank is much lower, so they prefer going ahead with funding the short term funding the assets with short term deposits. And even when the yield curve is sloping upwards, means if I am trying to fund for a longer term, the interest rates could be higher. So I prefer funding for shorter term, where the interest rates could be much lesser. So even that could create a huge gap. But the biggest problem is any refinancing that I want to do, I want to close out, or any new deposits I want to raise at a later point, I may have to raise them if the interest rates are going up drastically. Any new deposits that I have to any new deposits I have to accept at a later point, I have to accept them at a very high rate of interest, because the interest rates might keep growing up. So that is what we call as rollover risk. Refinancing cannot happen that easily, or even if it happens, it has to happen at higher rates of interest only. Then, so these two forms of liquidity risk is what we see. One, I'm not able to buy or sell because the price is moving drastically and no ample market associated with it. That is what we call it as transaction liquidity risk. Two, I'm not able to raise capital, or I'm going short of capital because my position is bad and my My lenders are demanding their money back. So there is the kind of internal cash crisis that is getting into my organization. That is what we are talking about, a funding liquidity risk. Then when I talk about these two together, they can even create a systemic risk. The whole financial system itself can get badly impacted, wherein huge losses. See, the biggest drawback with the financial system or the banking system is, in many transactions, right? In many transactions, especially the over the counter derivative transactions and all, what we see is most of these big banks, they act as counterparties to the others, or even in case of repos, repurchase agreements, many of these banks fund the other bank's repos. So if one bank is defaulting, there is a chance that this bank's liquidity gets impacted, this bank's positions get impacted, and this could be a counterparty somewhere else. So it creates a kind of a ripple effect, which can result in the whole banking system getting badly impacted. And that is what we are calling as the systemic risk. The chain effect or a ripple effect which is impacting the entire banking system is what we are calling as systemic risk. And there is a possibility of high amounts of correlation existing between transaction risk as well as the funding liquidity risk also. So while creating models, even these kind of correlations and interactions between the various forms of liquidity risk also need to be considered to a large extent. Then this is what we call as the fractional reserve bank system, wherein if we typically look at the asset profile of the bank, as I highlighted earlier, they are generally long term because majority portion of the assets of the bank are the loans. So some loans may be for a very short term period, but majority of the loans could be for long term, and they are less liquid.